Well, good morning, everybody. It is now October. We're in the fourth quarter, and it is quite an eventful market happening here. So we're going to, as people are dialing in, I'll go through the basics first, which is we like to use the chat for questions and conversation along the way. Jeff and Lael from the Altos team are in the chat so that they can try to answer questions on the fly. I'm not able to monitor the questions as I'm talking today. But as always, um, we like to hear where you're connecting in from, and we get, hundreds of people on these calls, so it's really great to see all over the country. The webinar is recorded, and you will get an email later today when the recording is up and available for all the registered attendees. Um, so let's just start rolling in. It is now October 10th. The big question on everybody's mind in the last few weeks has been, are we finally going to get some home sales? Is it finally going to pick up the dramatically slow pace of the last 2 years? As mortgage rates fell, particularly in September, did was that enough to motivate sellers? What could we see in the data? So we're going to focus on some of that today. I've actually got some hurricane market content and see what we can see there. We're also going to talk about the local markets, the inventory, the pricing, all of those things. Before I dive into the data, if you are new to Altos and you haven't already downloaded the free ebook, How to Use Market Data to Build Your Business, I recommend doing so now. There will be Lael and Jeff will drop the link in the chat for you to click through and go download that. It really helps you talk about the data in the way I'm talking about it today, help you understand. It includes things like scripts and scenarios and really like what are the data points to communicate? How do we do it? What are the best ways and how to use it in the business? So get that free ebook and it'll help you work along with me while I'm doing these webinars. So are home sales finally recovering? If so, how much are they going to recover? But also then, we've had inventory climbing all year across the country. Is that going to keep happening? Where our home price is going to finish the year? What visibility do we have for home prices? And then we have some really impactful local market stuff this week. We have the two hurricanes, and we can see some of those. And I've got some local market data for those areas. We have the big bifurcation that we've had with the Midwest and Northeast with low inventory, and the Sun Belt with climbing inventory for the year. And we're going to investigate whether that's holding up and what's next for the different local markets. So that's the agenda for today. Let's dive in. So let's start with home sales. There were 61,000 new single-family home sales pending this week, new pendings. For 2 weeks in a row, that's more sales than the last 2 years in that middle or the second week of October. All year long, sales have been maybe a little above last year, maybe a little below last year, but definitely below 2022. In 2022, when rates rose the first half of the year, people were trying to get the deal done. More sales were happening. You could see 70, 80, 90,000 single-family home sales happening per week in the first half of 22. But then in July, there's a big dip right in the middle of the chart, July 4th week, and home sales didn't recover. They fell again in September and October of 22 because that was a moment when mortgage rates went from the 6s to 7.5. There was a surprise jump at that time late in the year, and you can see really clearly what happened to home sales at that time. The home sales backed off in October of 22, and they haven't recovered until maybe right now. So we've had 2 weeks, and the dark line here is this year's curve. 2 weeks where we've had more sales than the previous 2 years. In September, in October of the previous 2 years, rates were climbing. And up till last week, mortgage rates have been falling pretty notably. We got around closer to 6%. But then suddenly, last week, we had really strong jobs numbers. So employment numbers came in strong. That kind of spooked the bond market. Mortgage yields went up on the 10-year and drove mortgage interest rates up from like 6.1 to 6.2 all the way to 6.5 or 6.6% this week. So we've had a spike in mortgage rates, and it's going to be really interesting to see how that carries. So some of the data we're showing right now, like these sales, is showing the momentum from mortgage rates getting closer to 6%. But some of the data we can show what happens when suddenly rates are back at 6.6 or 6 point, maybe even 6.7, because they're on their way up again today. So the good news is we finally see some loosening up. And for perspective on mortgage rates, what I've got here is the distribution of mortgage rates over the last 12 years. And each dot in here is the average 30-year fixed rate for a week. You could see most of the last decade is in that left turn bubble, that 2.5, 3.5 to 4.5 to 5%, that big bubble, most of the last decade. The last few years have been in the rightmost bubble, 6, 7, 8%. And in fact, most of this year was in the fat part of the rightmost bubble. We're around 7%, upper sixes, lower sevens. And when we were in that phase, the question I had was, as rates fell to 6.5, would that be enough to motivate home buyers? And what we noticed is, rates peaked in May at 8%, and then they eased down to 7, and then they eased down to 6.5. And at 6.5%, we still could really not see much motion for home buyers. But then a couple of weeks ago, rates fell further and we started getting close to 6%. And then suddenly we could see upticks in home sales. We could see, like I said, we had 2 weeks in a row with greater home sales than the last 2 years. And so you can really see these bubbles. Once we got to the left side of that rightmost bubble, close to 6%, we could finally start to see some sales moving. But then what happened? Well, like I say, I've said on these webinars often, I don't have an ability to predict mortgage rates. I've been wrong on mortgage rates for 30 years. Rates can go up, they can go down. It felt like they were peaked and heading back down, but we had a very strong spike. It just takes a little strong economic data, and the bond market says, wow, the economy is stronger than we thought, and therefore rates start going up again. So in the last week, rates have now bumped back over 6.5%. And so the question is, what do we see in home sales like next week, in the next 2 weeks? How quickly does it put a damper on buyers? We've been pretty lucky. Or is this a temporary jump in rates? Does it ease back down closer to 6%? The inflation numbers that came in today were nice and low, so maybe that's encouraging. Those are the variables, and there's all kinds of other variables. There's weather variables and there's war variables. There's those kind of things that are not predictable in rates, and so we don't know where they're going to go. But what we can do is say, what's going to happen if rates move back towards 6%? And I think we can see loosening in the purchase market as we get closer to 6%. But now at 6.5, I'm not so sure. We can see this. So I started with the Altos new pendings per week. So the new contracts, homes that are listed, they take offers and then they go into the contract process. That was where we started. That was up. It's been up for 6 weeks in a row, and it was up over the last 2 years. This is looking at the MBA's purchase mortgage applications. And for the first time all year, we had more purchase applications than last year in the last 2 weeks. And we've had 6 up weeks. And in fact, this week just came out and it ticked down just a hair for the week. But is still up over last year. And you can see these are, each line here is a year. You can see the 22 line, big drop in mortgage purchase applications at the same time the Altos pendings data dropped. You can see drops last year in purchase applications. They were already low. They kept going lower because in September, October, November last year, rates went all the way up to 8%. And so you can really see the you can see it in both of these numbers, both of the MBA's numbers and the real-time numbers from in the Altos data, in the Altos pendings data. And so, the question is, how quickly does 6.5 or 6.6, does that slow this back down? And I don't know, because we don't yet know, is it only 2 weeks of a jump, or does it climb all the way to the end of November like it did in 22 and 23? Those are things to keep our eyes on. The good news is that we could see some loosening and some improvement, some year-over-year improvement. It's not a lot of home sales, but it's improvement, and that's, I think, a positive view for us. However, if we look at payments, so what we're doing here is the median price of the new pendings, the sales price, the price people are paying for homes at the current mortgage rate. And we can see the dark line for this year peaked in May with mortgage rates. Prices have held pretty well, but mortgage rates have generally declined all the way into September. And then we had a sharp spike in rates. So we've had a 7% mortgage payment jump this week. And I think that may be enough to make a bunch of potential buyers put the brakes on and say, I'm going to wait a few weeks. I'm going to wait maybe till the spring. But that's really how you can see, the payments came down almost less than in 22, but then they've rebounded again. So we're in this really fragile zone. We could see recovery, but we can see exactly what happened in the last 2 years when rates spiked again. And so we're now in a little bit of a short rate spike. And so you can see how fragile any recovery might be. All right, let's switch over to inventory. There are now 734,000 single-family homes unsold on the market across the country. That's 36% more than last year at this time. Last year at this time, and in 22, in fact, inventory was rising pretty quickly in October and into November. Inventory didn't peak until the end of November. This year, I think we have another 2 or 3 weeks of rising inventory through the end of October. But inventory rose only about 0.4% this week. So it's like flattening out. Unless, of course, the rate spike really forces people buyers to wait, and then more homes build up. We have, at the same time, we have the hurricane impacts. So a lot of Central Florida, Western Florida. We have some of those counties in Georgia and North Carolina, which I'll get to in a few minutes. Those are, you're not listing your house for sale in Tampa right now. And so that will keep a cap on, a few hundred or a few thousand listings that will also keep inventory from climbing. There's some really fascinating impacts to what happens in those markets. Of course, our hearts go out to everybody impacted in those markets. It's crazy. We did a check from the Housing Wire team this morning, and the people in Central Florida, we got a bunch of thumbs up. A long night as Milton went across the state, but I was happy to hear that everybody was intact. And so I hope for your families and friends that is also true. As we're watching inventory, the next step is to also always watch the new listings pace. So there were 61,000 new listings this week unsold across the country. You can see just barely more than last year, 4% more than last year. Yeah, you can also see that it is fewer than the gray lines of the past years. So we still have fewer sellers each week than we did any of the previous years, except for the last two. The thing we're watching for in new listings, if mortgage rates fall, let's say they fall back to 6, we can start to see some activity. Some of the people who are on the fence, maybe they were on the fence as sellers who are waiting because they are locked into their nice cheap mortgage rate, but they really want to upsize or downsize, and they've just been waiting. So let's say 6% shakes some of those free, like it did in the last couple of weeks. The question is, and the fear that a lot of potential buyers and sellers have right now, the fear is that while when rates finally fall, there's a bunch of pent-up supply that sellers that are going to list their homes and it's going to flood the market. And then we're going to get things out of whack. We're going to have more sellers than buyers and we're going to have, therefore, that would create supply-demand imbalance and downward pressure on home prices. So there are buyers who are waiting, who are saying, I'm just going to wait on the sidelines until prices crash. And, they've been, of course, saying that for years. But now the thing they're watching for is if rates fall, does that shake loose too much supply? So what we do is we watch the new listings volume. And if that's going to happen, the first thing we're going to see is that new listings volume start climbing. It's got to climb above these gray lines. It's got to be more sellers than normal. And of course, what we see right now is fewer sellers than normal. So we don't see in the data any evidence of too many sellers happening. It's a valid thing to track, and it's a valid thing to discuss with potential buyers and sellers who are waiting, who are afraid. And the right way to do it is to say, look, the market cooled down. There are more homes on the market, but we can see that there's not a flood of sellers. Any seller who doesn't get the price they want, those folks have their cheap mortgage. They don't have to sell. A number of them, a lot of them don't have to sell, so they don't have the house on the market. They withdraw. They don't list, and as a result, that keeps a cap on inventory. It keeps a cap on the supply, and it doesn't allow that scary price scenario to materialize. So what I'm watching for in the new listings each week is I'm interested in getting us back to normal levels of new listings, getting the 2025 line into those higher grays, because that more sellers means more sales can happen. More sellers means more buyers. So I'm interested in a continued increase in sellers, and I think we will get another increase in sellers. Like we've had, the dark line is greater than the light red line this year, all year. I think next year we'll have another little lift there, and that will be healthier for the market. So generally, slowly getting more healthy. But I'm also on the lookout for, like, is there a surge? And if there's a surge, then we want to start looking at any imbalance potential. But as of right now, there's no evidence anywhere in the data of any kind of imbalance in the total sellers. We have, we talk about the new listings unsold. There's also the cohort of properties that are the new listings that are immediate sales. They get listed and they go into contract immediately. That is, there's like 8,400 of those this week. That's, as a percentage, just about the lowest we've seen since we've been tracking during the pandemic. And it shows us, though, that even though there's some home sales ticking up, we could watch the new pendings ticking up, there's no urgency on the buy side. So that implies the fewer bidding wars and fewer multiple offers. And that implies to your sellers that while home sales are ticking up, we still want to price the right way. We still want to price right from the start, because buyers are perfectly willing to pass on the overpriced house, on the not right conditions. And so that is something to keep in mind and something to be discussing with your potential sellers right now. Okay, inventory per state. So if you've been watching these webinars over the last few months, you'll know obviously that the Sun Belt states have had the greatest inventory growth over last year. And the Midwest, the upper Midwest, and the Northeast have had less inventory growth over last year. The redder the state, the more inventory change versus 2023. The interesting change in this pattern over the last few months is Texas right now, 44% more homes on the market than a year ago, but last month it was like 48%. 2 months ago, it was like 50% more. So inventory in Texas was climbing faster in 23 than it is now. Same in Florida. Florida was over 60% inventory gains last month. Now we're down to 55%. Arizona is at its peak right now, 70% more homes on the market than in 2023. But I have a feeling that Arizona is about peaked out as well. Now, on the other hand, New York was fewer homes than 23 most of the year. New York is starting to gain. Illinois is starting to gain off of the pandemic lows of inventory. And so what we're seeing is an evening out of the inventory growth straight. In general, what's happened is that as interest rates are higher, both mortgage rates and interest rates in the economy on bonds and things, we have not only are we buying and selling fewer homes, we're also doing things like moving less often. We are migrating from Chicago to Phoenix less frequently, from New York to Florida less frequently. In fact, Austin, Texas, and some of the like Sarasota, Florida had negative migration for much of this year, like people moving out of those areas. And so what used to happen, and it's also true with jobs. Unemployment is very low, but we're kind of nervous about that. As employers, we're doing less fires and less hires. As workers and employees, we're quitting less. So there's fewer hires, fewer quits, even though job unemployment is very low. We have fewer of those actions. And I've been calling it the great stay. We're staying in our jobs, we're staying in our homes, we're staying in our towns more than we did, especially through the pandemic when we had a lot of migration. So a lot of that's held. And so as a result, you can see it, the places we used to migrate out from are less inventory growth because we're not selling the houses there. And the places we used to migrate to, the Sun Belt, has greater inventory growth because we're not buying the houses there. So over time, as interest rates ease down and the economy allows us to do things like move more easily, those inventory changes will moderate. They'll be more even across the country. All right. Here's a fascinating way to look at how demand picked up in the last few weeks, but not yet with the most recent week's data in there. This is with the withdrawal rate. We're estimating the withdrawal rate. We can watch all the homes that are on the market. We can watch all the new pendings. And if your house is no longer on the market and it's not in contract, we can call that withdrawn. The dark line here is this year, and you can see it most of the year, more withdrawals than either of the last 2 years. And in fact, in September, I think when we did this webinar in September, we actually had we had about 30% withdrawals, which implied for every 2 homes sold, another one was withdrawal. And so for those through September, rates had stayed higher for longer, sellers were frustrated. And if you don't get your offer, you have 2 options. You can cut your price or you can withdraw the listing. And so we would see more and more people withdraw listings. That was keeping a lid on inventory, but also keeping prices from correcting down because sellers weren't getting the prices they want. Then what we noticed is then in the last few weeks, rates marched down closer to 6%. And each week through September, we had fewer withdrawals necessary. You could see that fewer sellers needed to withdraw their home. There were some of them were getting their offers. And so we are, in fact, this week had at 24% of the active inventory was being withdrawn. You could see that fewer than either of the last 2 years. And remember, the last 2 years, we had those big mortgage rate spikes and people were really discouraged. And so withdrawals were on the way up. And withdrawals climbed through the end of the year anyway, because now you get closer to the holidays and some people just want to take their home off the market for the holidays and then maybe put it back on in the spring. So you get a normal curve here. But we could really see the impact on the withdrawal rate over the last few weeks. Now, with the hurricanes and with the rising rates, I expect our withdrawal rate to kick up. So there's a lot of homes in Western Florida who are just, like, well, I guess, we're not for sale right now and we'll figure out what happens next. So those get withdrawn. There are probably a lot that should be withdrawn, but won't go through that process. So it'll still look like it's listed for sale. So there's probably, several weeks of that market correction to take place there. But this is what we can see over the last few weeks. And so we're really in this fine transition point where it looked like we're getting some sales, but then suddenly we got another mortgage rate spike. And so let's combine that all together to the forecast for inventory. So we're forecasting inventory to finish the year up 27% over 23. That's a pretty big gain, but it's actually less than we are now, right? So right now we're at 37% or 36% more homes on the market than a year ago. And because inventory was climbing so quickly, September, October, November last year, then therefore we're not gonna climb as quickly this fall. And so we'll end the year up at about 27% more. That's about 655,000 single family homes on the market at the end of the year. We'll start showing the 25 curve. We expect the 2025 curve to be up a little higher again. So get each year with higher mortgage rates, we get closer and closer to the old normal levels of inventory. So there's 734,000 right now. It's not that long ago that we would have had over 1 million homes on the market in the middle of the summer. And so, we still have 25, 30% more to gain before it even gets back to the old normal levels. And again, right, and I'll show you some of these. This is in the Midwest. It's in the Northeast. Many of those markets that still barely have more homes for sale than the pandemic. And I will switch into those in just a minute. Total sales pending. These are all the homes in contract. So 355,000 homes in contract right now. You can see there's a step each month. So at the beginning of the month, we close a bunch of sales, and then during the month they new pendings happen, and then they close. And so you can see the little step functions. But we can see home sales growth over 2023, and if we're lucky, as we go through October, you could see the dark line may finish higher in the fourth quarter than 22. What I think this is going to lead to is I started with a slide with the new pendings each week. This is all the homes in pendings, in contract. And what I think this implies is that in the fourth quarter, you're going to start to see some like bullish headlines from a lot of the other sources. They're going to say home sales are up year over year. Home sales ticked up. Home sales are up highest in the last 2 years. We're going to start to see some positive headlines, and that's going to be fascinating to see how the buyers and sellers react to that. If that motivates more action, like, oh, maybe there's things happening. So I think you're going to start to see some positive headlines because the fourth quarter of the last 2 years was really rough. And so maybe we get lucky. And you can see in the 22 line, the light red line, that steep drop in the total number of homes in contract in that October period when we had that second surprise mortgage rate spike of the year. Last year we had, we went to 8%, and you could see in October and November big home sales declines then. So, if we're lucky, we get moderating rates, and we finish the year up here above 22 and 23 with the total number of homes in contract. So these homes are in contract. It takes like 3 or 20, 25, 35, 40 days to close. So these are homes that'll close in October through the beginning of November. Now, at the same time, the hurricanes will impact the pending sales rate too. There are some big chunks of the country and some big metro markets that are really slowing down right now. And so let's take a look at those. Tampa Metro is obviously the biggest one. What I've pulled here from the Altos Advanced Analytics are the new weekly pending home sales. And so you can see several hundred drop last week from Helene. And then you're going to see another one from this week, and you'll see it again next week. Like, you'll see big drops down here. So you can see a really big impact. So knocking out, 800, 500 to 600 more home sales out of the national, like that's like 1% of the national home sales in a given week would come from the Tampa Metro and the surrounding areas, maybe 2% by then. We can also see it in the Asheville area. And so Henderson County and Buncombe County both had big dips in their new pendings. The other thing about the pending sales rate is there's a lot of places where if there's a named hurricane, even if it hasn't landed yet, insurance companies can't write policies. So if you're scheduled to close, you won't be able to get your insurance done. And so even if the house is safe, like there are those types of things that will restrict the home sales process. Maybe some of those will delay and get done in November, but a lot of those aren't going to get done. And so those are really under impact. And it looks like, Tampa and Sarasota and further south. Now, if we went all the way down the most like far southwest Florida, you can see less impact on sales. And then further up northern Florida, you can see less impact on sales. But I'll dive into Asheville and Tampa in the local data in a minute. But that's how you can see it impacting the national numbers from the hurricanes right there. Okay, let's switch over to prices. So the median price of single-family homes in the U.S. is $440,000. This is the asking price for every home on the market. It's unchanged from a year ago, and just fractionally higher than 2022. You can see we're like following this down. So it is the prices decline in the second half of the year. I had been, in the last few weeks, a little optimistic because we could see home sales improving, but now that's backing off. So on the low end of the range, home prices for 2024, we can see asking prices are essentially at a 0% gain from over last year. And that's roughly going to continue through the end of the year. On the other hand, if we look at the median price of the new contract, so these are the homes going into contract, these are the homes that people are buying. This has been up 3 to 5% over last year, all year long. So showing home price gains 3 to 5%. In August and September, as rates were staying higher for longer, buyers were getting discouraged. We saw the withdrawal rates climbing. We haven't gotten to price reductions, but price reductions were climbing at this time. So the price that people were paying was starting to tick down closer to where it had been. So it was getting in the 0 to 3% range. And then we had our little boost from mortgage rates. We could see our home sales increase, and we could see 4 weeks in a row of climbing prices of the new contract. So this is the price point that people are buying. And it really surprised me. I was not expecting buyers to be this aggressive to having it this visible in the home price changes. And so you could see, compare that to like 2022, the big mortgage rate spike in 22, you could see that sharp dip then, and we have a sharp spike now. And so what this shows us is how sensitive buyers are to payment changes, right? Payments had been declining. I showed the payments earlier. Payments had been declining for most of the year, and then we had a sharp spike. So it'll be really fascinating to see what happens with contract prices next week, and if it turns the corner or if it stays elevated. I expect it to ease back down. We're now 5% above last year at this time. So you can see asking prices are 0% above last year. The contracts the price people are paying are 5%. You've got a 0 to 5% range. And my expectation is it's going to ease back down into the 3 to 5% range. But because we had some good momentum, probably not closer to 0. It's probably looking at 3 to 5% home price gains through the end of the year. Given that we had dramatically fewer home sales, we had a hard landing in home sales. Home prices really showed a soft landing. Some markets are down, some markets are up, but nationally, this is the price point, $395,000. This is what people are paying across the country. Okay. And we talked about the state level migration and where inventory is higher in the Sun Belt and lower in the Northeast. Well, it turns out because inventory is restricted in the Midwest and Northeast, that's where the home price gains have been. 13% in New York this year, 10% in Wisconsin. So we could really see those tight inventories. You could see the northern states having much stronger price appreciation. Anything plus or minus 2% is flat year over year. Things can bounce around. So, all of these states across the South, even South Carolina, that's negative. These are all, basically flat home prices year over year. Some markets are up a little bit, some markets are down. But you can see the stronger appreciation in the Northeast and, the northern states across the country. So this is really that same function. We had been selling homes in Illinois and buying them in Arizona and buying them in Texas, but we stopped doing that because we've stopped quitting our jobs, we've stopped moving, we've slowed down on buying homes too. The great stay. All right, we're going to do price reductions and we're going to look at some local data. I've got a few different local things up for you today. And then we will wrap it up for the day. So there are 40% of the homes on the market have had price reductions across the country right now. If you'll notice, that's been in this range, 40%, for several weeks now. Price reductions were climbing late in the summer, and then they peaked at the end of August and have been bouncing around 40% or so. At that time, at the end of August, we had that spike in withdrawals. So if your house, you'd had a price reduction, you still didn't get your offer, you could cut your price again, or you could take it off the market. If you take it off the market, that makes this price reduction number drop a little bit. And so we had this cap in price reductions. Each of the last 2 years, with those spiking mortgage rates, you can see the real big spike in price reductions in the last 2 years through November, before the seasonal decline. Homes get taken off of the market over the holidays. The best fresh inventory comes on in the first quarter, and then if the house hasn't had its offer by June and July, that's when the price cuts start to accelerate. So you get a normal seasonal curve here. If rates go from here, we're at 6.5, 6.6. If they go up to 7, you're going to see inventory climb. You're going to see price reductions climb. You're going to see the withdrawals climb. All of those are going to be very sensitive to any buyers. They're perfectly happy to hit the brakes and wait for better options to happen. But we could see them start tiptoeing back in as rates got closer to 6%. So we can really see that threshold happening. Okay, let's switch over to the application and dive into some local data. First, I want to show you, so this is the Altos Advanced Analytics platform, and I've got some queries up that I am interested in. I could build my queries, and what I did was I'm interested in watching Dallas compared to pre-pandemic times. So this is Dallas inventory, and I can see here 26,000, almost 27,000 homes unsold in Dallas compared to like 21, 22, 23,000 in the years before the pandemic. So while I believe now I've been pretty optimistic national inventory about topping off the last few weeks, we really haven't seen it hit in Dallas yet. And I think this is a really stark comparison. Dallas is, a bigger market, tons of new construction, and it relied on inbound migration. So if that slows down, you can see a lot of difference over the last few years. I've also been watching prices in Florida. This is the pending home sales prices in Florida, and we can see earlier in the year in like April, home prices peaked and they've been ticking back down. I'll be curious to see if home prices finish 24 at or below the 23 level in Florida as a whole. That's something I've been watching. And I pulled up a bunch of counties in North Carolina too over here. Here's Buncombe County. You can see the new listings rate just dropping dramatically. Here's Henderson County. These are both Asheville areas, dropping dramatically. Yet if you go down to Charlotte, Mecklenburg County, no impact from the hurricanes. And I just wanted to see, I pulled up those because I'm interested in watching both new listings and new pendings. That's where we can see it most quickly. The impact of the weekly, like if I was going to list my house, now I'm not going to list it. And so these will drop even lower this week. But it was really fascinating. So I've got these queries picked up to keep my eyes on the impact of the hurricanes this year. Price reductions at the local level. We have Tampa is now at the peak, and it's fascinating, but Tampa ticked down this week with price reductions, and I'll show you why that is in just a second. But now we've got Colorado, Texas, we've got many of the Western markets are starting to dominate the price reductions, and that's different from earlier in the year when it was the Florida markets in the first half of the year. We still obviously have a lot of Florida markets in the price reductions peak, but and then here's Asheville down here with an uptick. So let's dive into some local. I've got the Asheville metro level report up, and median price in Asheville's $587,000. And it's been interesting to watch Asheville over this year. So home prices are still way up over pre-pandemic eras, but actually ticked down this year overall from last year at this time. If we look at the inventory in Asheville, we can see a few things. The long-term trend is Asheville, I talk about the northern markets and the Sunbelt markets, where people in New York is barely off the pandemic lows, but Florida is 50% more homes than last year. Asheville's kind of in between. So Asheville is climbing, is 50% more than last year at this time, but still just starting to come out of the pandemic and still significantly fewer homes for sale than pre-pandemic times in 2019. You can see where the demand is in Asheville, this is at $500,000. You can see the bigger lots, and you can see that that's the shortest time on market. Now, if we zoom into the inventory, what we'll see here is, let me zoom in even shorter here, is take this guy off. We can see, here's our inventory impact of the last week, ticking down like a sharp turn. And that's just the total inventory. So there's homes that are on the market that some will still sell, some that will need to be withdrawn that aren't yet, but you could see the little sharp turn of inventory in Asheville over the last week. On the other hand, Tampa is potentially more impacted. Tampa was last week with Helene, this week with Milton. We could see days on market climb. We could see prices adjust down, price per square foot adjust down. We could see the inventory turn right here. 10% fewer homes or whatever it is, 5-6% fewer homes in just 1 week there. Here's the inventory zoomed uh, in Tampa. But let's look at price reductions in Tampa. And so I'm going to turn this guy off here. We have, because we have a lot of withdrawn properties in Tampa, we actually saw fewer price reductions this week because there were a lot that are not on the market anymore. And so if they were sitting on the market for a long time and they did a price cut and now they're withdrawn, they're like, well, we have to wait until next year. So that's actually showing a downtick in price reductions rather than an uptick, which would be like, well, we're still going to try to sell this home this year. We just think it's weak demand. Like this is a more structural change in the Tampa housing market because those homes are no longer for sale. And fingers crossed that that's not worse than that, but that is what's happening in Tampa right now. Let's look at Cincinnati. So Cincinnati is one of the northern markets where we are barely up off of the pandemic lows, and in inventory, we can see a much stronger market action index. We could see the days on market is fewer than in places like Tampa. If we go down into the price ranges here, anything under $500,000 in Cincinnati is moving very quickly. Still 30 days at the low end, and even 42 days at the upper end of the market in Cincinnati. So you can really see that difference in the Sun Belt versus the northern economies. I have Sacramento up. I like to say the Sacramento housing market is like the whole US, only more so. It is the inventory trends, the migration trends, the price reductions. So price reductions in Sacramento really spiked in 22. It was a real recovery year in 23 and a slight recovery now this year. But not a strong market by any means. So it's a really fascinating trend to watch. We can see anything under 750 in Sacramento is where the action is. 49 days instead of 70 days if it's over $1 million. So Sacramento had, and let's look at pricing over time. We could show a little bit lower than last year at this time on the asking price. But like it's this time of year is when you get the down cycle in Sacramento. And obviously still significantly higher, a lot of equity for homes in the Sacramento region from 500K to 700K over the last few years. So you can imagine being a seller in Sacramento, not getting the offer you want, and you can reduce your price, or you can withdraw or not list it and say, I'm just going to wait because I have a cheap mortgage and I have a lot of equity, so I don't have any urgency to sell this house. I've got Washington, D.C. up. And inventory in Washington, D.C. is actually much more like, the northern markets, which is barely more homes for sale than the pandemic period. It's actually got from 4,200 to 5,700. So, a third more homes are for sale this year than last year. So slightly more, but still fewer than 22. And so the DC area is a strong economy. There's still a lot of inbound migration. So you can see what happens to inventory in there. That it's not like those Sun Belt economies that had a ton of inbound migration that suddenly stopped. You could see, still under a month on market for homes that are the cheapest, the entry-level homes, the first-time homes in the DC metro. So very strong differences in the metros. I do believe over the next year we will see these starting to moderate a little bit. We'll see more inventory, slightly inventory growth in the Northeast. We'll see some of that migration pattern picking back up again, and we'll see therefore picking up some of those homes in places like Texas. And in some ways, that's like optimistic for Texas and Florida and Arizona, because more homes on the market means better opportunity. It means for first-time buyers, for inbound migration. It means less upward pressure on home prices when we already have an affordability challenge. So in some ways, those Sunbelt markets where you build a lot of homes maybe are looking at a much more positive 2025. As I mentioned at the beginning, if you haven't already grabbed the ebook from Altos, I recommend that you do it. We'll put a link in the chat. Lael and Jeff will put a link in the chat. It helps you talk about the data the way I do, understand the data, use the scripts, use the conversation parts for your buyers and sellers, because they need to know what's happening right now, and that's what the data does. I don't have time to talk about every local market, but we cover every zip code in the country. So if you need to, you want to go understand your local market, you want to get started by getting the data to your buyers and sellers right now, go to altosresearch.com. You can see a demo. That's book a free consult with our team. We'll look at your local market. We'll start building your system so that you can communicate with your clients right away. All right, everybody, that's all the time we've got for today. Thank you so much. The webinar is recorded. You'll get an email later today when it's available. And thank you so much for sharing your time with us. I'll stick around and make sure all the comments in the chat are done, covered now, and we'll see you soon. Thanks, everybody.